All right, let's talk about value added tax. As you already know, that there are three types of supplies of VAT. Well, all right. If we talk about value added tax or VAT, there are very few concepts there are very easy concepts which we have to consider. The first thing which we should know is that why and when someone should get VAT registered. Well, I think whenever an individual is able to increase its prices due to value added tax, it would be good to get VAT registered as soon as possible because it will increase your profitability because VAT registration will decrease your cost of sales because of claimability of input VAT. Well, how this happens, let me explain that with the help of this example. For example, there was this trader who was not registered for VAT. And if he had to purchase something for 10,000, he has to pay 20% extra for that. And this 12,000 was his cost because he was not registered for VAT purposes. And when he used to sell these things for, let's say, 20,000, he was not allowed to charge any output VAT as he was not VAT registered. Now, if he would become VAT registered, still people will charge him 12,000 for purchases, but now this 2,000 would be a claimable VAT for him. And for this trader who is not registered, for VAT would be claimable. 12,000 has now been reduced to 10,000, thus increasing its profitability. Why he is to increase in prices? Maybe because he sells to who are already VAT. His customers are ready to pay more. So, in any case, if he is able to increase his price, and what happens to his profits? Well, earlier his sales were 20,000. And now, and his cost of sales were 12,000, and there was a profit of 8,000 he was earning. But now, his sales will still be 4,000, as this still be 20,000, as this 4,000 is payable to HMRC. So, still he would be incorporating sales at 20,000, and cost of sale would be 10,000 now, as 2,000 is recoverable, and the profits are 10,000, which are 2,000 more than the previous ones. So recoverability of input VAT definitely reduces our cost and increases our profitability, but this would only happen if you are able to increase your prices. But on the other hand, if he says that he would not be able to increase the prices from 20 to 24,000, but still he has to get VAT registered, well, in that case, he would have to sell goods for 20,000. But this time, this 20,000 is inclusive of VAT. Now, the VAT would be 3333, which I have calculated by 20 to 120 to 20,000, and so 16,667 would be his sales now. His profitability would deteriorate because now his sales are the 16,667 and his cost of sales are just 10,000 and the profits are 667, which are less than 8,000. So this is what the basics of value-added tax are. Now, further, we have to look into, as we were discussing so far, only one type of supply, and that was standard rated. But there are two more. One is zero rated, another is exempt. Now, keep in mind, when someone sells standard rated supplies, his input VAT is claimable, because he has to charge 20% output VAT. But if someone is selling, so output VAT is payable to HMRC and input VAT is claimable at 20% if claimable. But if VATs on your purchases, well, the bad news is your input VATs are not claimable and you would not be charging any output VATs. So, what is the difference within zero and exempt? Well, both traders does not charge any output VAT on their sales, but for zero rated input VAT, whatever they suffered is claimable, and for exempt, it is non-claimable. So, whenever someone asks you what are taxable supplies, well, that would be sum of zero rated and standard rated. And as we can say, exempt are exempt. That's why they are not taxable supplies. Now we know if someone is selling taxable supplies, his or her, if someone is selling taxable supplies, but if someone is selling, what if someone is selling both? Well, in that case, you would have to consider which VAT you are dealing with. Well, if it is a VAT which is directly attributable VAT, well, that means when we talk about input VAT, make sure input VAT is to be suffered whenever some payments, some expenses are to be made. Well, those expenses which are considered as direct expenses of taxable trade. If there are any input VAT on direct expenses of taxable trade, well, that is the input VAT which we call input VAT directly attributable. Well, make sure if there is any input VAT which is directly attributable to taxable supplies, either standard or zero rated, well, that is always claimable. Even you are selling exempt supplies. Because if there is any directly attributable VAT relating to exempt supplies, that is the one which is completely non-claimable. But if there is some VAT which belongs to expenses relating to all types of sales, including exempt, for example, overheads. So if we have paid any VAT on electricity, maybe on heating charges, on other charges, considered as indirect costs. Well, VAT relating to indirect cost is called unattributable VAT. Well, such VAT is to be apportioned according to the percentage of taxable supplies. We have to account for the taxable supplies divided by the total sales, that is including exempt, and we have to find a percentage and we have to round it up. For example, percentage is, for example, 78.2, you have 79. Even if it was 78.9, you have make it 79. This is what round up means. So this is how you differentiate within the input VAT relating to a partially exempt trader. Well, I will be discussing this de minimis limit in a while after we will be done with the following. All right. So over here, Arnold carries on activities which give rise to both taxable supplies and exempt supplies, for which input tax is wholly disallowed. Arnold prepares accounts to 30th June each year. Relevant figures for the year ending 30th June 17 are sales 96,000, 32,000, both taxable, and this one is exempt. So in order to find out that whether what is the percentage of taxable supplies, you should add them up both and divide them with the sum of all the three. So that would be 96 plus 32. So that is a percentage of 77.48. So we will round it up to 78%. So, but make sure the 78% is not to be applied on directly attributable input VATs. That is to be applied on input VAT relevant to input VAT which is unattributable. So, as far as input VAT which is directly attributable to taxable supplies, that is completely claimable. completely claimable and completely non-claimable. So if we want to make a table, something the way we had in the above performer, well, we can do so. So input VAT directly attributable to standard rated supplies. Well, that would be completely claimable as it is directly attributable input VAT. Input VAT relating to zero rated. Well, that is again completely claimable. But input VAT, which is directly attributable to exempt supplies, is surely completely non-claimable. And so far, we would say there is 14,000 of claimable, 4,000 of non-claimable, and 18,000 of total directly attributable VAT. Now, let's talk about unattributable VAT. Well, there's an unattributable VAT of 5,000 in respect of overheads. So, but make sure this 5,000 is unattributable and you would not be able to claim all of it, as we would only be able to claim 78%, as only 78% of the sales are towards taxable trades. So 78% of 5,000 is claimable. That is 3,900. And 22% is non-claimable. That is 1,100. And so we have 17,900 of claimable, 5,100 of non-claimable, and 23,000 of total input VAT. Now, this is the first step you should be performing whenever you are required to calculate recoverable input VAT for year ending whatsoever it was. Now, what is the second step? Well, the second step is, once you have prepared this table, you should check the de minimis test, because right now, as of in our calculation, there was 7,900 claimable. There was 5,100 non-claimable, and there was 23,000 total input VAT. Well, this non-claimable input VAT could have become claimable if both of the following conditions are fulfilled. Well, let's see whether this 5,100, which is non-claimable, could become claimable or not, which I am saying would become claimable if it will fulfill both of the following de minimis tests. So, what are the de minimis tests? Well, the first condition is that exempt supplies are less than equal to 50% of the total sales. Well, right now, our exempt supplies are 22% because 78% are taxable supplies. Next, total input VAT is on average less than equal to 625 per month on average. Well, right now, the total input VAT which we have is 23,000 divided by 12. So that will be an average. So 1917. So we did not fulfill the first test. But don't worry, we have an option of the three. We have to fulfill any of these three, and the second condition would be met. So let's have a look at the second one. Total input VAT, that is 23,000, minus input VAT directly attributable to taxable supplies. Well, the input VAT which was directly attributable to taxable supplies was 14,000, because these are the directly attributable VATs to taxable supplies, that is 14,000. So 23,000 minus 14,000. Total input VAT minus input VAT directly attributable to taxable supplies is 625 per month on average. So divided by, now that's 750. That was close, but no, we did not fulfill the second condition. So now we have one last chance. Total non-claimable input VAT. Well, total non-claimable input VAT so far is 5100. Let's divide it with 12 in order to find out. Well, that is 425. Well, that means we have fulfilled the third condition out of the three. So if any of the three is fulfilled, we'll say second condition is fulfilled. When first and second both are fulfilled, this 5100, which was non-claimable, is now claimable. So in this case, this 23,000, whole of this 23,000 is claimable from HMRC, as de minimis test has been fulfilled. Now let's have a look at the second requirement. Also explain what would be the annual adjustment required if Arnold has actually claimed 20,200 during the year ending 30th June 17. Well, now you know that this amount would be given in your exams, and this amount which he should have actually claimed is, I have just told you that how to calculate that. Well, the comparison of both will be the additional amount which will be still further receivable from HMRC. Well, the next thing which we should consider in VAT is land and buildings. Well, as far as land and buildings are concerned, they are a bit important in VAT. Why? Because all the commercial land and buildings which we will be dealing, for example, if it's a question of corporation tax, a company would obviously be buying and selling commercial land and buildings. For example, if it's a question of a sole trader and individuals, once again, he will be buying and selling commercial land and buildings. So those one are, and along with a trading profit, there would be another requirement relating to VAT. And in that, if it has to be building, it would be a commercial building. Now, what is commercial building actually is? Because we can see commercial building in standard rated 2 times and in exempt for once. Well, any commercial building for which an option to tax, an election for option to tax the building has not been made, would be standard rated for only 3 years of its completion. Otherwise, if you want it to be a standard rated supply, you must make an election and opt to tax the building. Because if you would do that election, it would remain a taxable supply for your business even after 3 years of completion of construction. But if you would not opt to tax the building, make sure a commercial building which is not opted to tax would become an exempt supply automatically after 3 years of its completion. And so whenever you will be selling this building, you might have to repay some of the VATs which were claimed in the year of purchase. So keeping this thing in our mind, there's a topic called capital goods scheme. Capital goods scheme, which says that if a land and building costing 250,000 or above has been purchased by a business, well, HMRC would consider this land and building for 10 years. And if it is computer and computer peripherals, HMRC is going to consider it for 5 years. Consider it for what? Well, if you are a completely taxable trader, well, in that case, there would not be much of a problem. But if you are not a completely taxable trader, if you are a partially taxable trader, in that case, and the building would be used for all aspects of your trade, in that case, this calculation would be much more relevant. Well, how it would be relevant, let me explain that with the help of this following example. Confusion PLC is a company that buys a new freehold building for 52,000 5,25,000, I think, including VAT. 40% of the building is used in making exempt supplies and 60% for taxable supplies. After 7 years, this changes to 50-50. Now, the problem is that building is going to be used for both taxable and exempt. So I should consider the input VAT of the building as if it is unattributable input VAT. And that's why 5 to 5,000 into 60% into 120 over 120, that is the VAT which I would be able to claim initially. So when the building was purchased in year 1, you would only be allowed to claim 60% of the input VAT, as the building, as your business has turnovers, taxable turnovers of 60% only. So that's why only 60% of the input VAT would be repaid to you in year 1. And in all of the subsequent years in which percentage would remain fixed at 60, you would not have to pay or receive any amount in all those years in which percentage would remain 60. But as we can see, in later part, after 7 years, the percentage becomes 50-50. Well, we claimed VAT initially in year 1 on assumption of 60 on figures of 60% taxable supplies. But now, if they would reduce to 50%, you would have to repay HMRC some of the VAT. And how you're going to calculate that? Well, first you should calculate full input VAT. Well, 525,000 was not full input VAT. That was only 60%. Well, the 100% would be answer to this. 5,250,000 multiplied by 20 over 120. Well, that would be 8,75,000 pounds. So the total input VAT into 1 by 10. Why 1 by 10? Because we do adjustment for every year. If it would be 50% again in the next year, we will be doing the same calculations again. So we do adjustments for VAT in capital goods scheme on year by year basis, and that's why 875,000 into 1 by 10 into the percentage which was in year 1 and the percentage which is now. So now it is 50. Originally it was 60%, and now as you had already claimed 60%, but now you have reduced the percentage of taxable supplies, you would have to pay to HMRC 8750. Now, if, for example, it would have been, rather than decreasing, if it would have been increased, and let's say the percentage to taxable and exempt supply would have, rather than becoming 50-50, would have become 80-20. Well, in that case, in any year, well, in that case, the calculation would have been 8,75,000 into 1 by 10 into 80 minus 60, and whatever the answer would have been, that would be receivable from HMRC. So this is what we do in 10 years adjustment period. And if the same building has been sold, if the same building has been sold within the 10 years, how do we deal with that? Let me explain that with the help of the next example. Delta PLC is a partially exempt trader. Delta PLC is a partially exempt trader and makes 30% exempt and 70% taxable supplies. So if it is going to purchase any building, only 70% of the input VAT would be claimable in year 1. On 1st March 18, Delta PLC buys a new freehold building for 2 million, including VAT, which used in the same proportion, which used in the same proportion. After 2 years, Delta PLC's percentage of use of building changed to 40% exempt and 70% taxable supplies. After further 3 years, Delta PLC ceases the exempt trade and makes only taxable supplies from there on. Well, I think you should consider this example at your own, as there has not been any disposal in this example. So it is quite identical to the one I explained earlier. So I think you should give it like 2 to 3 minutes and read it carefully. If you have any problems, I'm here. You can discuss those. Okay, let's discuss this example. Well, in year one, you would only be able to claim 70% of the input VAT, as we can easily see the taxable supplies were 70%. But after a few years, when the percentage changes to 60%, well, in that year, once again, you should calculate the full input VAT, whatever it was in year one, divided with 10, and then the percentage which was at the first place 70, and the percentage which is now 60. So 3,333 is due to HMRC. But from year 6, when they stop making taxable exempt supplies, and all of the supplies becomes taxable, well, this is the time when you would start to claim in every year whole 10,000 of input VAT back. How? Well, you just calculated full input VAT, took 1 by 10, and this time the percentage will be 100 minus 70, and that's why 10,000 would be receivable per year. Now, let's talk about overseas aspects of value-added tax. Well, as far as overseas aspects of value-added tax are concerned, first we should have a look at that whether the sales, whether it is exports which we are doing or imports which we are doing, is outside European Union or it is within European Union. Because if it is outside European Union, it is quite easy, because all of your exports which are outside European Union are zero rated. Well, this is what I suggest to my students, that you should consider all the sales at once and then all the purchases on the other hand. Well, students are usually interested in learning things, how they happen outside and how they happen within European Union. Well, I would say don't do that. Rather, you should remember them. What happens when we do exports either outside or within European Union, and when we do purchases. So, first, sales. Well, these are sales which are outside European Union. These are sales which are within European Union. And again, these are sales which are with. So first thing which you should prepare while your exam preparation would be sales, exports. And the second thing would be imports, and imports which are within European Union. Now, let's have a look at each of it in more detail. Exports which are outside to a country which is not in European Union, well, these exports are considered as zero rated worldwide, and that's why output VAT would be charged at 0% and all of your input VATs would be claimable. Well, same happens within European Union exports as well, but make sure only if your customer, if supplier and customer both are registered businesses. Well, in that case, again, your supplies are considered as zero rated, and supplies are considered as zero rated. And once again, your these upon these sales, you would not be charging any output VAT, and all of your input VATs would be claimable. But if you are selling something within European Union, but your customer is not registered, well, in that case, make sure you must charge standard rated VAT to that customer, and make sure whatever VAT you have charged, that is payable to HMRC, and your import VAT would be claimable. So as far as sales are concerned, outside European Union, they are zero rated. Within European Union, to a registered business, they again zero rated. Within European Union, to an unregistered business, yes, that is something which is standard rated sales. So most of the sales outside UK are zero rated, except these are sales to unregistered customer within European Union, in which case it is standard rated. But on the other hand, if we talk about purchases, well, if there are purchases within outside the European Union, and these purchases, um, well, let me explain the purchases with the help of this example. For example, in your exam, there is this client company A Limited who says that we want to import a production plant from China, that is outside European Union, which will cost us £100,000. Well, make sure, as we just studied the rule of sale of outside European Union, well, that is zero rated. So in this case, our Chinese supplier would not charge any VAT, and the goods would, any VAT, or I must say Chinese VAT, in his country, as from his country, it would be considered as exports, and it would come zero rated to UK. But in UK, when your things would be at port, dry port, or airport, or point of collection, and when you'll go to collect them, you would have to pay 20% VAT at point of collection. But whether this input VAT, as it is, I would call it input VAT because it is on purchases, whether this input VAT would be claimable for your organization or not. Well, the answer to this question would be based upon whether this this production plant would be used exclusively for taxable trade, for exempt trade, or for partially exempt trade, and plant would be used for all aspects of business, that is exempt as well as chargeable. Well, if this production plant is going to be used for taxable trade exclusively, well, all of this 20,000, that is 100% of amount, would be claimable. Well, all of this 20,000, nothing would be claimable. Whole of this 20,000, whole of this 100% 20,000 would become non-claimable because it would be used for exempt supplies. And if this would be used for partially exempt trader, and that partially exempt trader is, let's say, 60-40 to taxable and exempt trades, and it would be used for all aspects of trade, well, in that case, you would have to pay 20,000 at point of collection, but you would not be able to reclaim all of it, as you would only be able to reclaim 60% of that, and that will be £12,000. So in first case, we can say the plant cost us £100,000 because 20,000 was paid at port and 20,000 was reclaimed. In second case, we would say the plant cost us 120 because we paid 20,000 and we did not claim anything. Well, in the third case, we would say the plant cost us 108,000 because we paid 20,000, 12,000 was repaid to us, only 8,000 was not repaid to us, and that's why 108,000 would be the cost which would be suffered by this company. So, if the purchases are made from outside European Union, this is what we do. But if these purchases are made from within European Union, where you and your supplier both are VAT registered, well, in that case, reverse charge procedure applies. Now, what does reverse charge procedure means? Well, in that case, I would say only the payment method would be changed, but not the payment. Well, this input VAT of 20,000, which was paid earlier on the point of on the point of collection at port, airport, and dry port, well, right now, this is not to be paid at the port, but you have to make it a payable VAT in your VAT return, in your coming VAT return by yourself. So you would be first making it payable, and then you would be making by yourself whole of the amount receivable, none of the amount receivable, only 60% of the amount receivable, just the way we did earlier. Well, the only difference is that if these things were coming from China, that is outside European Union, well, in that case, we had to pay this amount and then get it reclaimed. Well, if this is coming from Germany, that is from within European Union, well, in that case, make sure we will not pay this 20,000, rather we will make it payable, and in the same return we will make it completely receivable if it is completely used for taxable supplies. We will not make a single penny receivable in the same return if it is completely used for exempt. We will claim 60% of this amount in the same return in which we have made it payable if it is used for all aspects of 60/40 trader. So the things are almost same except for the payment method. With outside European Union, you would have to pay this amount on the port, but within European Union, you just have to account for this VAT on your VAT return at your own and then reclaim. And that's why by making it output VAT, payable VAT, and then receivable by your own, on your own in your VAT return. That's why we call it reverse charge procedure. Well, as far as services are concerned, firstly, we would have to look into whether the services are provided to whether the services are provided, services are been sold or services are been purchased. Well, if the services have been sold to overseas business customer, well, when services are performed in some overseas country, the place of supply is not UK, and you must not charge any output VAT if the customer is an overseas business customer. Well, if the services are sold to a non-business customers, just the way we did earlier, you should charge standard rated VAT to them. But if you are purchasing services, any services which are being purchased by your client in the paper, I would say in a very simple way that reverse charge procedure applies. That is, that anyone who would be coming into UK to provide you services would not charge any VAT to you. It would be you who would be charging this VAT at your own, and then first you will be making it a payable VAT, just the way you did for goods, and then you will be making it input VAT depending upon which type and of trader you are and how you are going to use these services for. So reverse charge procedure always applies in purchase of services, but in purchase of goods, reverse charge procedure only applies when purchases are from within European Union. All right, the next thing which we have to discuss is group VAT registration. Well, as far as group VAT registration is concerned, for that, let's have a look at corporate structure. A Limited owns B, C, and D Limited. Let's say 80, 60, and 90%. And let's assume they have not signed for any group VAT registration so far. Well, right now, what would these companies be doing? Well, A, B, C, and D, all the four companies would have been preparing their own VAT returns and should have been submitting it to HMRC at their own. So far, if B Limited wanted to do some sales to C or any sales within the group, if there are any sales within the group, for example, if B makes some sales to C, it must charge output VAT to C. And then C should claim that VAT, claiming it to be an input VAT. So, if the things are been sold within the group, they would have to charge VAT to each other. Secondly, they would have to submit as much returns as much companies do we have in a group. Well, if you want to get a group VAT registration, there are two very simple conditions. When two or more companies are under common control, and number two, companies must be UK resident. So right now, B, C, and D are under common control of A. So if they want, they could get themselves registered as a group VAT registration. So if they would do that, what are the benefits they would be seeking for? Well, if there would be a group of companies, we would say, group VAT registration, we would say the first benefit is that they would not have to file that much VAT returns as much companies we have in the group. So now, for A, B, C, and D, there will be only one VAT return to be submitted to HMRC. So the first benefit, rather than preparing 4 VAT returns, they would be preparing just one VAT return. Secondly, now if there is any intra-group sale, those would be exclusive of VAT. That is, you need not to charge any output VAT to any of the fellow members if you are if you have registered as group VAT registration. Well, the third benefit is that you can elect any of these group members to be any company out of these group members to be VAT representative, and from now onwards, all the VAT communications would be done by that members, and all the formalities would be held by that member. All right, and the fourth benefit, generic benefit, would be that if you want to exclude any of these companies, yes, you could. But in the exam of P6, examiner is sometimes asking us something more than these 4 generic benefits. Well, these are the benefits which you might write in every group VAT registration. That you would have to submit one VAT return. There would be no VAT on intra-group transactions. There would be one VAT representative, and we can include and exclude any common control company we want to. But there may be some specific things other than these to be explained in the exams. Well, what is that? Well, for that, just assume A, B, and C were standard rated companies, but D Limited is a company with 0 rated sales. Now, if I ask you that if A, B, C, and D becomes a VAT group, register for a VAT group, what are the implications? Besides discussing the first 4, in this case, you should discuss another very relevant to the scenario implications of group VAT registration, which is, now, to consider that group VAT registration, firstly, let's get rid of the group. Like, if there was not a group within A, B, C, and D, well, in that case, as these 3 were standard rated companies, their returns would have payable to HMRC. But a company which involved only sales which are 0 rated, that means output VATs are 0 and input VATs are claimable. So for them, their returns would have been always claiming VAT from HMRC. Well, now if you will register them as one entity for VAT purposes, return of D Limited, VAT refund of D Limited would now be set off against payable of A, B, and C. And the impact on each company should be discussed separately. For D Limited, you would say before group VAT registration, there would have been cash refunds on every submission of return of D Limited. On the other hand, for A, B, and C, if they are profitable companies, for them, there would have been always cash payable to HMRC because of output VATs and input VATs are both there. But once they would be in group, they would be considered as one entity, and all the refunds of D Limited would be settled against payable amounts of B, C, and A. And from now onwards, D Limited would never be able to claim that refund, as that refund would be settled against payables of A, B, and C. And what is so there's a negative impact on B Limited, but there's a positive impact on B, A, B, and C. Why? Because their payable amounts would be reduced by the amount of receivable of D. So this is what you can explain. And another specific implication which he may ask in the paper would be this one, that A, B, and C are standard rated supply companies, but D is wholly exempt supply company. And D's turnover, let's say, for example, represents 30% of total turnover of group. All right. Now, if one of them are zero rated, you may discuss the payables and receivables are to be net off. D is not going to get any refund anymore, and A, B, C do not have to pay that much as they used to pay earlier because of refund. But when D Limited is an exempt company, well, that is affect the claimability of unattributable VAT of A, B, and C, because earlier any unattributable VAT of A, B, and C were completely claimable before group VAT registration. And for D, unattributable VAT was completely non-claimable. But now, when they would become a group for VAT purposes, well, now it would be a group which is considered as 70-30. 70% taxable and 30% exempt, but make sure percentage is only applied upon unattributable VATs. Directly attributable VATs would still remain claimable and non-claimable completely. But unattributable VAT, which was completely fully claimable, would now be claimable only 70%, because now it would be assumed that as if this is a partially exempt group of 70-30, as they will be considered as one entity. So for A, B, and C, there are not good news of becoming group registration. Why? Earlier, their unattributable VAT was completely claimable, but now their unattributable VAT is only 70% claimable and 30% non-claimable. But for D, unattributable VAT, which was completely non-claimable, after signing for group VAT registration, now 70% of that VAT will become claimable, which is a good effect for D. So in this case, D would be a happy company and ABC would not, because their 30% input VAT is non-claimable on unattributable input VATs. Well, that is all from my side.